This is Greg Crabtree with the Simple Numbers Consulting team here to give you a presentation on kind of the rules for surviving and thriving in a crisis, and then how to develop a plan for your funding needs. So we've developed kind of a two-part process. We're going to do one video that we're going to go through kind of what the process is of how you need to think. If you have the cash flow planning tools, this will kind of help you think through in the way that we've been doing calls with clients to go through this process. The second video, we're going to actually go through several case studies of examples where we've taken access and blended data of what we have access to in terms of what we're seeing, and created 4 data sets that's an adaptation of examples of businesses and industries, and kind of what those businesses turn out to be. And the reason why it's important to understand that is not every business is the same. And so this is a classic situation that we're in right now, of facing the fact that profitability and cash flow are 2 different things. And we're going to see some wildly different examples as we go through those case studies. As we sit here today in March 20th, what we don't know is kind of, how long these things are going to go. So we're going to go through kind of a process of giving you some examples of kind of, you'll probably do a couple of different versions of this, but we'll go through it. So the first, with me is Veronica Cram and Mike Maxon from our consulting team. Veronica has been instrumental in helping me develop, this information. Mike Maxon is our director of client services, who coordinates with our clients anything that we need to help them on, and works out those scopes. So my goal is we've developed this in a way that you can be self-sufficient. I've always believed in the idea is we want to make sure people own their own situation and can do everything that they can do. If you need help, we can certainly help you. But really, this is more so, I want everybody that watches this to roll up your sleeves, own your own data, own your own existence, and really, it's not going to be easy, as much as I love the concept of simple numbers. But this is a time where you really need to be in touch with how things move, and this is a perfect situation of you understanding that balance sheet thing that you never look at as an entrepreneur. You only look at the P&L. Well, now's when you really need to understand how the 2 work together. And I think we've come up with a way that's a little more intuitive, that I think as you work with it, you'll really grasp it and find it extremely useful. So let's get into the plan. We don't know how long this is going to last. I mean, many cities in the U.S. as of today are in shelter-in-place rules. Some businesses can still work from home, but not, there's a lot of the workforce that's not able to work from home. And so you've got to be prepared for really a hard 90-day plan, I think, in many cases. And then you may be in a particular business. We've got a couple of clients that are, we've had to do 180-day plans, because this is a particularly selling season for their business, to where whatever they don't sell now, it's pretty much lost on them until January of next year, potentially, or something like that. And so in those cases, we got to do a 180-day plan. Hopefully for the vast economy, this will be something that, within 90 days or sooner, with hopes of some of the therapies coming out, that we'll be coming out of this a lot faster but you'll still have a 90-day significant impact as certain businesses come back online, and whoever needs your services comes back online and is ready to pay for them. So whether we are back at work sooner than 90 days, we're still all going to be impacted over the next 90 days. Once you create those 2 plans, then you're going to look at the cash required. So the profit creates some of the negativity towards cash, but it's the cash total that we've got to have a better way of calculating, in this process, so that we can then know how much do we need, where can we go get it if we decide that we need to really, press on and keep this business going. And when we say, is it worth it? Clearly there's going to be some businesses that are better off to just go dark and save whatever resources they have, or not lose more from what they have, to then, come back and restart a business. Hopefully more will choose to kind of press through, and we have an unprecedented support in the U.S. from Small Business Administration. Other countries, it's going to be one of those that you just have to look at. Is there going to be government assistance, or you have to go to an investor, or how much latitude would the banks in your region have, in that process. So apologies to my international friends, that may be watching this. I don't, I've not run across, any of the international programs that might be available, but I'm sure there's going to be, similar ones out there, much like, what we're looking at. So let's get into the process. So step one is, the first thing you're going to do is plan out gross margin. And notice that we don't say plan out revenue, we say plan out gross margin, because you have to understand that this is a time frame where your cost of goods sold may act in a different way than being a direct variable cost to your revenues. So some businesses that have kind of a fixed amount of cost of goods sold, and their revenue declines, they're going to have a more negative gross margin production. And so just to understand that you've got to pay particular attention to the gross margin creation. Take an example from the restaurant industry. You're going to be able to still produce meals for carryout. Well, but if your business is based on liquor sales as well as food, they're not going to let you do carryout drinks with open containers, and so you're not going to have the same margin, and your margin's not going to be the same percentage either, because you're not allowed to sell the things that you normally sell. So you got to think through those things and allow that to happen. Now, in our terminology of simple numbers, gross margin is revenue minus cost of goods sold that do not include labor. So we've not really talked about labor yet. We're going to hold that till later. The second thing is you're going to look at non-labor expenses. Secondly, we're going to hold labor till last, because I want to look at anything that we can turn off, from facilities to delaying rent to turning off any discretionary expense. And apologies to my marketing friends out there. Marketing is going to be, turned off in many cases, because you don't have customers that you need to be attracting at the moment because they're not ready to buy. But you're going to turn it back on as fast as possible. So one of the things I've said in my talks is, we look at our marketing clients as the canaries in the coal mine. They're the first cost to be turned off in a downturn. They're going to be the first cost to be turned back on in an upturn. And so we'll be watching those businesses quite intently, as people come out of the restrictions of business and those things. But I suspect that they'll get turned back on quite rapidly. But that'll be on a case-by-case basis. But whatever you can turn off, the thing is, don't expect that they're gone forever either, because a lot of these costs you can kind of delay or kick the can down the road, but they're going to come back potentially, later on. So just be mindful, as you look at that. One of the buckets that you'll see in our model as we look at, as we call it, other operating expenses, and that's kind of a catch-all bucket of all of the things. And you're going to be surprised as you go through and decide what to turn off. You're going to probably be faced with some decisions that the cost of turning it off and then later turning it back on is greater than, hey, we probably just need to leave it on. So just keep those things in mind. Once I go through those, then I'm going to deal with direct labor. So direct labor is more so, who do I absolutely need if I'm producing gross margin? So concept that everybody kind of get through their head. If you're a restaurant and you're not serving food, you're not doing any takeout or delivery, you're just closed, you don't have any direct labor that you have to spend. Now we may come back and decide, yes, we're going to spend that, and we're going to support our people, which a lot of our clients are choosing to do because they have the resources to do it. That's a final decision. That's not a this step part of the decision. You're going to say, what do I have to keep going, in that process? Also keep in mind that we've gone through, 12 years of grinding through the employment market in most of the countries, and especially in the U.S. and Canada, of trying to build effective teams of people. So be careful not to destroy those teams of people that you built, because somebody else who has resources will pick up those good people because they can. And so understand, we've already seen that in a few cases already, of where more people, more really good people are available than a long time that we've seen. And so just be mindful of how hard you turn that off, and did you really need to do it, or are you just playing it too close in that process? You're going to look at management labor last, of saying, of the management team, obviously I got to have a management team, when I come back out. But, you may also be able to look at it and say, those are generally going to be the higher paid people, that you have on your staff. But you may also look at abilities to them to take temporary pay cuts or suspend pay, to some degree. And so those are situations where, I kind of liken it to, many of you have seen the movie, It's a Wonderful Life, with Jimmy Stewart as George Bailey, and the famous scene in the savings and loan when they have a run on the bank, and he tells this lady, how much do you need? And she says, I want my $27. And he says, I didn't ask you how much you want. It says, how much do you need? And she asked for, well, I need $2. And then he kisses her on the forehead and thanks her, because that's the thing that you're trying to get to give ourselves enough runway, to stay in the game as long as we can in that process. So after we look at management labor, then you're going to evaluate your resources, and that's where you look to the model and say, hey, how big of a hole am I going to dig, and do I have access to debt, disaster loans, investors, and then you kind of go back and do a couple of more iterations of cutting harder, cutting faster, cutting less. Every time we've gone through this discussion with clients, in the past 3 weeks, is they've come out with a different decision. Now, here's the harsh reality. Some have come out with a decision to cut faster and harder. Most have come out with a decision, oh, I'm not in as dire of straits as I thought. But you can cut both ways. And so just be prepared for that. The thing is go through the exercise and let the data tell the story, rather than you manipulating the data to create the story you want to tell. And that's the key, in the process. Okay. So a couple of things to keep in mind. Every business model has a distinct profit and cash flow signature. A restaurant doesn't generally carry much in receivables unless they're in doing events. And even then, for those events, they generally carry deposits in excess of that number. But a services firm, like what we do, we have receivables from clients, but sometimes we get to bill in advance and bill on retainer and work ahead. Those things are all going to change, all is going to vary. In manufacturing, I get 30 to 60-day terms on my supplies. Well, is my supplier going to continue to be able to supply me? Maybe not. Or in other circumstances, it may be a situation where they can support me. They need me to stay in business worse than I need help from them. And so all of those things have to be taken into consideration. In this time of crisis, you just need a keen understanding that when does your profit turn into cash? Sometimes I have to put cash out first to then make the profit. Sometimes I get the profit and then it later turns into cash. So just understand. I would say also expect a disruption of normal terms. Expect to get paid slower. Be pleasantly surprised if you get paid more timely. I would expect that you'll have to pay faster. So as you deal with vendors that may be in damaged situations, you may have to pay faster in order to get the goods and stuff that you need. Let's hope that it doesn't get too much out of normal terms, but let's understand that. And if you carry accounts receivable or inventory, it's generally going to be easier to get direct assistance from your lender with those collateral items. The SBA has indicated that you may not have to have those to get lending assistance, but it may restrict in terms of how much you can borrow. But keep in mind, there's a difference between those business models who have receivables and inventory versus those who don't. And so then, and we're going to look at actually 4 examples here, on the next video when we go through that, and go through those processes. So first, let's do a little education, because not everybody has the same level of understanding at the moment of understanding this difference between profitability and cash flow. So this is data that is actually extracted. This presentation is taken from my next book that's about ready to be released, Simple Numbers 2.0, Rules for Smart Scaling. And so in this research that we've been doing over the last 10 years since the original book came out is really honing in on the private company part of the economy. And one of the things I will tell you is fortunately in the U.S., private companies have become a significant dominant force in the U.S. economy. And so I personally believe, based on what I've been studying in the last 10 years, is that we're going to rebound out of this much faster, because I actually think the smaller businesses are much more nimble and much more capable to rebound than certainly some bigger businesses struggle a little bit and lumber a little bit in terms of turning things on and getting customer demand back. But I think we can really flex and do much better in the private sector of businesses. So in our study, we came down to this and said, well, listen, it's not really about industries. It's about there's really 3 types of business models that exist. You either do stuff, sell stuff, or make stuff. And you can really learn from those three types of business models. Now, you may do a combination of those things. So you might sell the stuff that you manufacture. Well, if you do, then we actually get those businesses to think distinctly differently, in the sense that you have a sales organization and you have a manufacturing organization. And you may want to really take a look at and say, what am I world class at? Am I world class at making stuff, or am I world class at selling stuff? And if I can't be world class in both, well, maybe I need to outsource the one thing I'm not world class in and just do the thing I am. And those can certainly be good understanding to these, in this process. Let's look at 3 examples. So I've got a manufacturing, a sales organization, and a service organization. And you can see quite distinctly different revenue numbers, but yet not dramatically different net operating income numbers down here. So on $4.4 million of revenue, the manufacturer makes almost $700,000 in net operating income, or what most people would refer to this as EBITDA. And so, so really in this particular case, I prefer the net operating income. I think is a more appropriate term to describe it. And so they're making $700,000. But the first question I always ask people is, is this a $4.4 million business, or is it really a $2.6 million assembler of stuff? And the reality is it's a $2.6 million assembler of stuff. This is really the true economic impact that this company makes. And so that's really kind of, where you want to have your head. And so notice the distinction here is that we look at net operating income not only as a percentage to sales, but also as a percentage to gross margin. And I would say one of the advances that we've done in the last 5 years is really to where we look at this number on both of those numbers. And I've become more of a fan of really evaluating a business profit on gross margin than on revenue. Revenue is such a vanity number. And you'll see it in the sales business. Let's kind of talk about them. $40 million of revenue. Hey, that sounds like, big deal, but only a 13% gross margin. And so in this particular business model, very, very tight margins, high turnover, but very efficient. And so in their case, I would say, are they a $40 million business, or are they a $5,350,000 inventory management business? And that's really what they are. They've generated $5.3 million of economic value for what they've structured. And so they've got to stay really efficient with their direct labor, have systems and processes to move those products through their warehouses and get them sold, and choose the right products and make sure that they don't have stale inventory and all of those kind of things. But a 3.68% profit number, which is not that exciting, except when you look at it as a percentage of gross margin, you go, oh, 27.48%. Well, that's better than 26.69. So they're better than the manufacturing business. And so think about that and go, that might be something you may want to consider. And then we have a classic services business, $10 million of revenue. You can see that very little cost of goods sold. This 500,000 represents just contracted, subcontracted out services that they pass through. They're the billing face to the customer for that 500,000, but they make little to no margin. They might make 10, 20% margin on it, but it's not much. And so ultimately, when you look at them, they're at a 12% profit to net operating income, but very little leverage increase to gross margin. So when you look at these, I always ask the question in the class when I present these, and I say, well, which business would you rather be in? And so invariably, I've kind of precluded their thought process to where they kind of jump to the sales business. They like the 40 million, and they like the 27% profit to net operating income. But we also talk about things of going, listen, if my margin shrinks, I don't have a whole lot of room to go here, in that process. And so you just got to look at this business with a little different eye. And you can see that on the services business, I don't get a great, net operating income to margin on here. So they never pick the services business. And so usually it's a trap question, because when I ask them that question, I says, what would you say if I haven't given you enough information to know? And the reality is it's true, because the real key to evaluating profitability is return on invested capital. It's how much capital do you need to turn these businesses over, and they have a dramatically different signature, in that process. And so as we look at the 4 Ds of capital, here's the net income of each one of those businesses as a percent of revenue. But you can see the manufacturing business carries some receivables, they carry some inventory, but they also get accounts payable coverage from their vendors equal to their inventory. So it's not officially consignment, but it's effectively consignment in that process. So they can see that they only have invested in this concept of trade capital, $542,000. Well, what the heck is trade capital? Well, trade capital is quite simply working capital without cash and debt. In studying these businesses, what dawned on me is working capital is one of the dumbest calculations we've ever come up with. Now, I know that's a harsh statement, but I'm going to challenge all the accountant types out there of saying, listen, trade capital is what's forced on us by the marketplace. Debt and cash are choices that we get to make based on availability and sources of funds. Either I have the cash or somebody else has the cash, and they like what I do. And so we refer to the cash and debt as buffer capital. So cash minus line of credit debt's buffer capital. And then there's only one other capital piece, which is infrastructure capital. And so that's essentially your net book value of fixed assets minus the debt directly associated with those fixed assets. And so essentially what I've done is create a 3-line balance sheet: trade capital, infrastructure capital, and buffer capital. The sum of those equals my capital or my equity in the business. And so from that standpoint, no more left of the balance sheet of assets and right with liabilities and capital. And I don't understand how all these things work, and I can't predict them, because yes, you can predict them. Yes, you can. And the thing is we got to connect them in a way. And notice what I've done here is I've netted the current assets that work off of each other against the current liabilities that work off of each other in that process. Now, let's go to the next level of learning. Net trade capital of $542,000 as a percent to revenue of 12.3%. So the question there is, why do I need to know that? What does that number mean? Well, it means a lot, because it actually is the big aha. If my trade capital is 12.3% and my profit is 13.3%, I have the infinite capacity to grow without burning cash. For every dollar of revenue of growth that I add to my business model, I only use, what is that? 87% roughly, of that in cost, and I make 13% profit. And of that 13% profit that I create, I got to use that to add more accounts receivable and inventory minus accounts payable. But I can grow infinitely in that process. And if I look over here to the sales business, they're at 3.1% net income. Trade capital is 1.9%. Now notice their structure. Their accounts payable, they're getting support from their vendors that covers both their receivables and their inventory for the most part. Now, this is a business that's going to really be sensitive in this current environment, because those vendors might start not be so generous to keep giving them, credit. And so therefore, this is about, closer to, 75-day terms, that they have on it. And so if the 75-day terms go to 30-day terms, this business is upside down on the cash flow train big time. And because the small percentages with high volume, that cash flow thing flips big time, and it'll whack you, in that process. So great business model when things are smooth and consistent. It's a little challenging. So they better have some capital, they better have some reserves, and they might have to go, ask for, some temporary capital assistance from the SBA, to get through times of crisis. The services business, they're still in a positive trade capital to net income number as well, but only because of this number. They have $1 million of deferred revenue where they've collected money in advance on projects that they've yet to do. In a tight market like this, expect this to be a lot harder to get. You might actually have to agree more to defer stuff. And so it could be easy. Typically, a service model that doesn't use deferred revenue, this trade capital percentage shoots up to about 12 to 15% of net operating income. And so then if you're only at 10% profit and you got a 15% number there, you are burning, for every $100,000 of revenue, you've got to invest $15,000 of your own cash to turn it over. You're only going to make 10% profit. So your net $5,000, spending that's out there in perpetuity that you got to keep adding until you overcome it and you level off. The simpler aspects of capital, infrastructure capital, like I said, this is net book value, fixed assets minus debt. For each of these, much less infrastructure capital requirement in the services business, much more in this business because of their inventory management processes. Buffer capital, you can see, is biggest for the service business because it's all labor. For the most part, it's everything you don't get terms on. Well, because this business doesn't get any terms, you better fund all your labor. So these are examples. But here's, at the end of the day, here's your defining thing of saying, in a normal environment, which business is best? Well, the sales business actually gives us a 57% return on invested capital. They are producing $1.2 million of net income. Just consider interest income, to equate it to a bond. It's like I went and invested $2.1 million in a bond to get back $1,241,000 in profitability. Now, I may have restrictions on removing that, understandable, but that's what it made. And so that creates a 57% return. Last time I checked, 57% of return higher is pretty good. We've done this calculation for all of our clients we do consulting for. The average return on invested capital for most of the businesses we work with is about 75%. Many of them are over 100. But if you're at 50% or less is kind of where we think 50% is kind of the minimum acceptable pre-tax return on invested capital. And that's kind of the evaluator as you look at your business model going forward of what's good, in that process. Okay. So let's talk about key simple numbers to the P&L model. So gross margin, as we said, is the true top line of the business. You want to break out labor. Never, ever, ever mix labor with something that's not labor. It is the classic error in data analysis of financials. There's a reason why public companies don't tell us what their labor numbers are. So as private companies, we know what they are, and let's look at them, because understanding, labor is really kind of the key. If you're a smaller business and you don't have a clean distinction between management labor and direct labor, just put it all into direct labor right now and just put it all there. But if you can make a distinction between the two, we call it a butt and a bucket. So separate it by people, not by, don't do percentages and allocations. A person is either all direct labor or they're all management labor is our recommendation of kind of how to deal with that. Contribution margin, we believe contribution margin is the most important number to monitor because it's the pure, clean output of the business engine. So when you look at this number right here, you're monitoring this both for dollars and percentages to say how clean and efficient is this engine of margin that I haven't loaded for overhead, I haven't loaded for other costs. I want this clean picture, and that's going to be the cleanest number to really understand and move forward with. Then in terms of our two signature labor efficiency measures, direct labor efficiency ratio, LER stands for labor efficiency ratio. So that is this number right here, this 2.89. So you can see the distinction of how people make money in these three businesses. A manufacturing business has a moderate labor efficiency ratio for the direct labor. They get $2.89 of gross margin for every dollar of direct labor. A sales business that is leveraging technology and infrastructure and automation, they're getting $4.86 of labor of gross margin for every dollar spent. And then the services business is pretty much, hours billing, kind of concept. They only get a 2 for 1. So when you're into commodity services, even though they may be professional services, the marketplace is kind of telling you what the commodity factors are in that process. So in this case, that one's a 2, but if you're really good at it, you might get as much as a 2.3 to a 2.5. If you're in the staffing industry, you could see this number drop to, 135 to 150. In some of those ranges, and those are turning over a lot of activity. Staffing industries generally, if they don't get any payment in advance on deposit, the staffing industries are one of the toughest ones to actually get the trade capital at a reasonable number compared to profitability. But it can be done, and we have clients who've successfully modified their business model to accomplish that in that process. Then we have operating expenses. So kind of when we talk about operating expenses, it's more so separating them into these 5 buckets that we believe in, because it's less about fixed and variable costs that we're taught in accounting school. It's more about function of cost. And so our belief is these 5 magic buckets are really kind of the gold standard of understanding how things work. So I have facilities, those are infrastructure costs, rent, utilities, repairs and maintenance. Things that pretty much are hard to turn off. You can delay them maybe. Marketing is a discretionary spend. So if you don't have any gain from marketing spend, postpone it, but then come back with a vengeance and use it when the time is right. Management labor, we already talked about. Payroll taxes and benefits. This is payroll taxes and benefits on both management labor and direct labor. I'm not a fan of loading direct labor with taxes and benefits. I like to keep them all in one bucket so I can monitor them and easier calculate them. And then other operating expenses is the great catch-all bucket of everything that isn't in these other 7 lines, they go into that line. And so what you're going to find is it's a number that bounces up and down on a monthly basis. On a rolling 12 basis, it's pretty smooth. It's not going to really change much. In a situation like this, you can go through line by line, and I wouldn't spend a ton of time on it because there's not a lot you can do. Now, if you can do something, it's a discretionary cost, yeah, turn it off. But beware of the bite back. It's that thing that you turn off might bite you back too. That just be careful. Did you really need to turn that off? And this has a bunch of line items to it, but it has the least amount of significance in the grand scheme of things, unless maybe you're paying for consultants or something like that that can be postponed, and those kind of things. But mostly like your property and casualty insurance, your workman's comp insurance, office supplies that are necessary to run your business in an effective way. You got to kind of keep those things going, in that process. So really, you're going to go through those. And then the last piece is other income and expense. Generally, I would say going forward, you're going to try to understand if I've got interest income or maybe some interest expense on these. But these are one thing I will note as you work through these. A positive number is income and a negative number is an expense. So just understand the dual signage of it. These also have we show this model. I have a discussion about reinvestment expenses of where you're spending money of what we call launch capital expenses. And so that's a place to capture there. I've seen a suggestion to where you might can use this for COVID-19 expenses. You know, I mean, you can put it there. I generally like to see expenses stay in their functional category of where they would naturally be. But if you have an unusual cost that is totally related to this and it's not part of normal operations, absolutely use one of these lines down here, you know, for that expenditure, you know, in that process. Um, so one of the things to reiterate is understanding this. So once you know your profit percentage relative to your net trade capital percentage, this is what we call the CPR for business, cash power ratio. If I can get my profit percentage to 10% and my trade capital percentage is 5%, you can see I'm in the cash flow free growth zone. Grow as fast as you want. I will not need anybody's funding. My profits are funding my growth. If my trade capital is at 10% and my profits at 5%, I better find a funding source. Simple as that. And so what's been amazing is once we kind of made this number appear on our clients' balance sheets for them to watch and monitor, they finally started doing something about it. And it's been amazing to see trade capital come down in terms of how much investment that they really needed in their business because they grew a backbone to actually go ask for the proper terms. And amazingly, they also realized I got to get my profitability up. I got to do both. And when I do both, I create magic leverage in terms of cash flow in that process. And so it's huge, huge, huge benefit, you know, to people that understand it. And this is a time more than ever where you need to understand that. So to summarize, the idea is trade capital percentage compared to profit percentage is really the key that you got to hone in on during this cash flow and during a business slump. And so a way to think about it is simply this. Trade capital plus buffer capital is the old working capital. But these two things are totally different. Trade capital is forced on you by the market and market conditions, and it can come and go by market conditions, and that's what we're highlighting here. But secondly, buffer capital is a choice. I have a choice to put my own cash in. I have a choice to go borrow money personally to then put into my business. I have a choice to go find an investor. I have a choice to go apply for an SBA loan. Those are different things. And so we have long since totally messed up entrepreneurs' understanding of capital requirements of businesses by throwing two things together that don't belong. They support each other, but they should never be looked at together, in my opinion. And so, so really from that standpoint. And then the last piece to kind of summarize, trade capital plus infrastructure capital, buffer capital. So when I say 4 needs for capital, where's the fourth one? Well, the fourth one is launch capital. And so we don't have enough time today to go into that. So there's a pretty extensive chapter in the new book on that. But launch capital, think of it like this. It resides on your P&L. So these first 3 are on your balance sheet. But this one resides in your P&L. Well, how does capital reside on your P&L? Well, simply, it is an expense that you choose to spend that nobody makes you spend. It is an expense that you spend that is deductible in the business, and you're making a bet that it will create future growth and margin creation of the business. And you might be successful in that bet, and you might not. But the idea is we've developed concepts of how to track those expenditures that are not forced on you by the absolute necessity. Think of what we do is we create a normative P&L of here's normal operations of income all the way down to expense. Now, what are the things that you spent money on that was just a wild guess of hoping that it's going to create some new gain? And did it do it? And so the key is we've developed these techniques to really look at how to isolate these spends and say, how good of a bettor are you? Because I want to teach you how to have better odds and quit doing the stuff that fails too much of the percentage of the time. And let's do the stuff that has a greater, higher probability of succeeding. And so we in the book, there'll be some examples of kind of how to go through that, you know, in that process. All right. So with that, Veronica, Mike, any questions or comments or clarifications I need to throw out there based on what I've said to this point?
I don't think so. Not on my end.
Yeah, I think you're good.
All right. Good deal. All right. So we'll, a couple of things I won't spend too much time on. This is an example to kind of help you see the trade capital example in a traditional balance sheet. These were distributors' that we looked at. And so you can see that I just extracted the trade capital pieces and you net the two. And you can see in this particular case, I mean, this is the classic case. These guys actually have negative trade capital. What the heck does that mean? Well, that means that this business was getting $500,000 at that moment in time of funding from their vendors to run their business. And so they had 1.4 million of cash, but 500,000 of that 1.4 million wasn't theirs. It came from their vendors. This company, now this is a classic case of people understanding why this matters. They had 726,000 of their vendors support. Oh, wait a minute, they only had 210,000 of cash. Somebody was spending money irresponsibly. And that's what that means. And if you don't calculate it, you won't see it. And that's why it's important. We've got a couple of exercises here. We won't spend time going through that. You'll see it more as we go through the templates. But here's an exercise on how to calculate trade capital, as well as then the final step of it is, if profit is higher than trade capital percentage, then, hey, let's use launch capital to grow, because everything that I grow with, I'm cash flow positive. If my trade capital is higher than profitability, then how do I increase profitability or reduce trade capital? That's a classic, strategy of how to deal with it. Oh, I'm sorry. And then, the other thing is you're going through this trying to identify the accounts of where to put them. Do they fit in trade capital, infrastructure capital, or buffer capital? You're going to eventually run into some accounts that don't fit in any three. You know what those are? Those are things that don't belong in the business. Those are non-business assets and liabilities that you, as the owner, reached your hand in the piggy bank and actually used the business to buy those. Now, not to say that you can't do it, but guess what? They just cloud your understanding of the actual clean business model. So typically and you'll have to deal with this in terms of populating the template. Generally, it's other assets or, shareholder loans or those kind of things. You're probably just going to take all those, ignore them, and net them against equity. And that's actually, to be quite honest, that's what the bank does when they do the evaluation of your balance sheet. They take all of those things off, net them against equity, and act like they never existed. And so that's what we're going to do as well, in that process. One of the things to kind of remind people, as you climb back out, what are we aiming for? We're aiming for living up to the 5 forces of cash flow. So in the original book, I called it the 4 forces. But since my research on return on invested capital has kind of come out, I really have to add this 5th one. The first thing that you're going to choose to do, because your business is producing a return at greater than 50% return on investment, is I want to make reinvestments in the business to grow it and get it back to where it was. And so that's the first thing, because most of those investments are generally going to be people or marketing, and both of those are expenses. So I got to know those 2 numbers first, because those are deductible. And I got to know those before I then calculate what my tax liabilities are. Now, one thought on tax liabilities. We're going to get some extension of time to be able to pay them. We've got to keep in front of ourselves what we still owe that's sitting in our bank account. Now, it's great that we get to use that cash, but you also got to be mindful of the fact that I can't spend it, and this is going to be an interesting conundrum that some people are going to be faced. We got clients that had significant amounts that they were allowed under payment rules to pay on April 15th that, they're going to lose a lot of that income in this year. And so it'll be interesting to see if there's some type of mitigating circumstance to allow you to take a 2020 loss back against 2019, but never pay them the tax differential in the meantime. So who knows? I have not heard that discussed, but they haven't thought that far yet. But that's where a lot of people are going to be, is you're going to have losses this year, and you'll see that in some of our case studies in the next video. But as you set aside the tax liability, then you're going to repay your lines of credit or whatever you pulled on. Then you're going to continue to build back to your 2-month or better core capital target. Our clients who have followed this principle, they're the ones that are not in distress. And so they're doing fine at the moment. And as long as we don't get in a protracted shutdown, they're actually going to come through this just fine. And last of all, keep your hands out of the cookie jar on profit distributions as long as you can. Now, hopefully, as owners of the business, you set aside some personal funds and you've got some runway that you can, it's your call of whether or not you can take a salary or not, but at the end of the day, I really want you to not be taking distributions, until the business gets back to full health, in that process. This is an example of how that's calculated. So you can see in the 3 business types, you can see that the manufacturing business, they have the smallest of the core capital because, they get terms on their COGS. And so it's just their labor and their OPEX. The highest core capital number is the services business, just because of all the labor. And that's always going to be that case, in that process. This is an example of a balance sheet that you can see, traditional balance sheet presentation that I've really converted into just the 3-line version. Notice the extra 170 here of the non-business assets. Generally, what I would do is just show their balance sheet as $1,950,000 of trade capital, $780 of infrastructure, $950 of buffer, and then take that 170 out of it altogether, because that 170 is nothing's going to happen to it during this process. It's just going to sit there. So if you just net it against equity, their real active equity was at about $3,680,000, I think, is the sum of those 3, in that process. And then lastly, we don't have time to do a different presentation, but as you're ready to grow and launch out of it and spend risky money to bet your way back into health, that's the launch capital process. I put this in there just for you guys to cover. You're going to identify the initial new spend. These are all expenses. These are not capital items. These are on your P&L. And these are choices. Nobody's going to make you spend these things, but you're going to feel the need to spend these things to create it. And so the way we want you to look at it is identify the spend, this catalytic activity to grow the business back. You're going to forecast how much are you going to spend or how much you're going to lose because you're spending that extra money, and that represents launch capital. And then if that number, say, is $100,000 that you're going to spend, well, I'm going to expect at least a 50% return on that. So if I spend $100,000, that's a pure bet that I don't know if it's going to work or not. I better see my profit increase by 50% of that number, a profit increase by 50,000 within 12 to 24 months, and preferably 12 months in this environment, which means that if I get a $50,000 increase in profit, I've recouped my cost and made 50,000 on top of it. That's how the way to look at it. You don't look at these spends relative to revenue. Absolutely, you maybe can evaluate it in gross margin production. Yes, that helps, but the harsh number, and this is what I'll cover in the new book, you really got to look at net profit, and we got a great case study in the new book, to kind of go through that, in that process. And so with that, we're going to go through this monthly P&L forecast on the next video that will walk you through kind of how to do this and really see month by month. Here's what I've actually done, and now where am I going, in the next example. So we're going to cut it off here because most likely you're going to have to probably relook at the template instruction video more than once. So we're going to break the video here so it'll be a little bit easier to access it. So Veronica, Mike, any other questions on this that you want to touch on before we get into the examples on the next one?
Yeah, one of the things you did, I'd like to hear you mention in your CPR, your cash power ratio, where you're looking at the debt, capital, and time concept there in terms of that. If we just run through that one more time.
Yeah, and so think of it like this in a sense that, so what are the ways that I have to fund the business? Well, obviously I can go borrow money. In this current environment, this is an unprecedented access to debt borrowing that, now I don't ever mix debt and capital, but a debt is essentially a placeholder for capital. And SBA is, I think, is what, about 3.7%, I think is what they were saying, 3.25%, somewhere in that. It's below 4%. So the idea is that's incredibly cheap debt, but it's not capital. The only way to repay debt is to produce after-tax profit. So I will eventually have to repay that debt, but at a cost of less than 4%, that's an incredible opportunity. You just have to know that I am going to create enough positive profit and margin after tax in the future to retire that debt. Now, and the unusual thing is you're getting long-term payment terms on what is typically a revolving short-term note. And so it's a good thing if you're successful. It's a horrible master if you're not, because you got to get profitable to pay it back. I mean, you will eventually have to pay it back. And so the key is make sure that you know that you can generate that profit engine. Otherwise, so time, it is the ability that if I'm in a services business and I can work for free, I can, get my family to stuff envelopes or do whatever, I can do. And I can donate my time, and maybe I have a spouse that isn't in a situation where they're still in a situation where they're making enough income that I can survive on. That salary that I go without, we call that sweat equity. And so sweat equity is absolutely the most common capital component, and it's the one that pays you back the most if you can pull it off. And so certainly that's a good description. And then capital, if you actually go get an investor, that's going to be the most expensive. Now, some businesses, that may be the only way that they make it. So you can convince somebody that it's worth the risk. So just be wise in terms of how you structure it. And as I always say, I always want to know, if I take on an investor into a business, I want to know how I get them out of my business. And that's an important thing in terms of structuring. So good questions on that. Veronica, any thoughts you've got?
No, I don't have any questions. I think the next video is going to be really applicable, where, our clients and just folks out there can just input their actual numbers and kind of see how much cash they're going to need to get through the crisis. So.
All right. Sounds good. All right. Well, we'll wrap this one up and see you on the next video.